Welcome, you're listening to The Best of Investing on Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And we have a lot of new listeners, so for you guys, imagine this is what our format is. Okay, imagine a bunch of guys sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Lou Batmale of LPL Financial. And today's trivia theme is, it happened during the 1970s.
Ouch.
Yeah. Well, you might be able to get a couple of these.
Why can't we get drinks? That's what I'm wondering. Right now. It's been a rough week.
Oh, yes, which we'll get into that in just a minute.
Yes.
You've got some excellent news for us. This is going to be one for the ages, this show. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. And we're also on television, Comcast Channel 26 and AT&T 99 on Saturdays at noon and Sundays at 6 p.m. Now, Lou, you are going to bless us all with the information about Obamacare.
Let's start with, it's commonly known as the Affordable Care Act, but most people coined it as Obamacare, which is appropriate. Barack Obama put the law into action, and everyone is somewhat confused. Intimidated is another word. Somewhat confused, intimidated, don't want to research it. I mean, by and large, our listening audience, maybe 30% would be affected, maybe 20%. It's not everybody's going to go to an Obamacare.
Well, I tried to call the president to ask him questions, and he hasn't returned my call yet.
Well, he was a little busy this week with the crazy
shutdown?
lady that rammed the White House, but
yeah, negotiations have been tough with the White House. Well, I mean, I think the most important thing you do on the show is give people some information. Let's start with the website, which has changed as of October 1st, which is this week, and it's coveredca.com, www.coveredca.com. It's a great resource. It's very comprehensive. You're not covered by an employer's insurance plan. This website's a good place to start asking questions.
Now, you said Covered CA, like
right.
Covered California.
Right. It used to be Covered California. It changed.
Okay, but wasn't there something called healthcare.org or something like
Right,
that?
that's a different website. So a lot of these websites have changed in the last week, literally.
Wow,
So some were like you can ask questions about how it might impact you. Now they want you to actually input your actual information, possibly some income information, your family members, and then see what type of plans.
To get like a real quote as to how much it's going to cost.
Correct,
Okay.
correct. And what I mean, the big overriding theme here is watch your benefits. Your benefits could be disappearing if you go into the exchange versus what you have currently. If you're in an employer plan, by and large, you might want to stay with it right now. And there's a lot of kinks in the system. Is that a good technical term? Kinks in the system? There's a lot of things here that need to be worked out. We need to actually experience it. So I'm going to go through some of the provisions you can to maybe hold off Obamacare for a year if you want to. So let's get started here. So Covered California is the exchange established by the state of California. It was required by Obamacare. And it'll be one of the avenues to purchase health insurance coverage beginning in 2014. So open enrollment starts now, October 1st. You must enroll by December 15th. Write that down mentally. December 15th, you have to enroll in the plan.
If you're going to...
If you're going to utilize the plan through the exchange.
I'm writing this down,
Yeah.
12/15.
So the size of your family, your income determines if you're eligible for government reductions of insurance premiums and copays. For example, a family of 4 in the Bay Area, this is a pretty low number, an income of $70,000 have premiums of $1,053 per month.
Wait, I pay less than that now for a family of 4. Now I have a high deductible.
Correct, but you also don't have some of the offsets that Obamacare or the ACA or Affordable Care Act provides premium reduction. Also, you have to check and see, in your case, what your copays are, what your prescription medication provisions are, and things like going to the emergency room or going to see specialists.
Oh, yeah.
All these numbers are changing.
God, it's so hard to figure out.
It's difficult.
My plan is so bad that I'm covered unless I get hurt or injured.
Yes, that's how a lot of people are. So, I mean,
they just collect premiums. They don't pay.
The big hope here in the Affordable Care Act is that people actually, young, healthy people, join the plan. That's the only way it's going to work.
Well, that's the whole thing about insurance, to offset the people who are unhealthy.
Yeah. So this is kind of the big thing that no one really knows yet. I wanted to kind of broadcast it out there because these are layers of documents you have to search through. So I went to a couple different resources and talked to a few experts. Another way it's going to impact is the new provider networks that are available in the individual marketplace. So some people who are offering Medicare or medical insurance might start or stop offering it now. Most of the big names are still in the plan: Kaiser, Anthem Blue Cross, Blue Shield. But there's some provisions to that. You want to determine if the current providers are included within the network or of your new health insurance plan. So if you go to a certain hospital, there's a chance that your Obamacare insurance might not be covered in that hospital.
I guess the thing I'm a little confused about was there was something about it was going to force. What was Obamacare going to force?
Okay, so
the employers?
that's a tax. They let the employers off the hook. So the first step was 50 or more employees, you had to have insurance, or 50 and under, excuse me, you had to have insurance. They let that go for a year. This is the whole thing. This is the tweaking that's going to occur over the next 12 months.
Okay.
So that was the first thing. The second thing was you have to pay a penalty. So the way the math works out is like this: if you don't have any insurance, you go to the doctor, you have to pay about a $95 penalty. If
That's
you
not
get
so bad.
if you get insurance, it's $150 and you're covered. So what you rather do? They make it negligible. Now that number, that $95 number, is going to start growing, depending on how many people use the program. So you see how all the variables are going into this thing. So this is the big thing for people listening in the Bay Area, especially, and online. There's a great hospital here called University of California, San Francisco. It's a passionate part of me. I had a daughter with cancer, so we went through that system. And it's our understanding right now, as we stand here in October, Anthem Blue Cross is the only provider in that network. So if you are currently at UCSF, you need to call and find out if your coverage will be applied to UCSF in the future if you're not with Anthem Blue Cross.
Okay, I'm with Anthem. Are they going to be proactive and get in touch with me as to what I should do based on my circumstances?
Probably not.
Yeah, that's
They're
what I thought.
going to mail you. You're probably going to get 3 or 4 pieces of mail in the next 2 weeks discussing your current insurance, the fact that you can log into CaliforniaCA.com and look at the different options.
Okay,
That's really
coveredca.com.
right. That's really where you are right now. And they want you to determine what's best for you. So someone who's the backbone of America is built on small businesses. All of us in this room run some form of small business, and that's where this is going to have a lot of impact because people are going to say, well, gee, it's better to be part of the exchange, or it's better to have our current insurance program.
Yeah.
So I want to jump on that real quick. If you're an employer paying for medical coverage, you may or may not be eligible for the government helping you pay for your premiums and copays through the Covered California Exchange. If you're an employer, you will need to review the cost, benefits, and networks of your existing plan and determine if a change is needed. New insurance carrier, renew your plan on December 13th to delay the impact of the Affordable Care Act in 2014. That's important. You can renew your plan now, and it's good for 12 months. You change your renewal date.
Why do I feel like going da 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 da? I feel like I'm in a circus.
It is a little bit of a circus because in the end they included the insurance company. So this is not socialized medicine like you find overseas where the government's going to take care of you like Medicare. This is not Medicare. We're utilizing the insurance companies. There's tax offsets. There are different programs. I mean, in the end, looking through everything, less benefits, more costs is where this thing started.
If I get hurt, can I take you to my doctor and you can kind of explain this to him?
Many doctors are already determining what they're going to take and not take, and that's the end result. I mean,
and the doctor also gets to decide whether he's going to take
it's
insurance.
Like some doctors don't take Medicare anymore, right? I mean,
Yeah.
I've had a few clients who go through that scenario.
or Medi-Cal.
So if you have the opportunity to renew before 2014, I suggest you do it. I suggest
with your existing
carrier.
Yep. We just did this month.
Right, so
our Kaiser plan for the company.
Right, so next October you have to worry about it again.
Okay,
That's
now
over.
I don't have a company plan. I just have individual one where I just each month they just send me a bill and I pay it. So I don't necessarily renew for another year. I'm kind of on a month to month, aren't I?
No, you have a renewal date. Anyone who has an insurance plan has a renewal date. It's not renewed on a quarterly or monthly basis. It's renewed every year. So that's when the things change. So
Yeah, I don't even know when my renewal.
yeah, so you want to call up and find out. That's probably a good key to
Tell you what, hold on to that thought. Lou Batmale from LPL Financial is quite experienced here in Obamacare.
Like the Obamacare expert here.
I'm lost in all the reading I do.
But yeah, listen, you've got much more information about this than I do. Okay, we're going to cut to our first commercial break. Again, the theme is it happened during the 1970s. What legendary Southern rock group had several of its members killed or injured during an airplane crash on October 1977?
Oh, Mr. Carter. Mr. Carter, I know this one.
Mr. Carter. The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort, which, by the way, I was in school when this happened, and I sort of like when people say when JFK got shot, where were you? I was too little for that, but I do remember this one. What legendary Southern rock group had several of its members killed or injured during an airplane crash in October 1977? One more time, 888-912-1190. Make sure to include your name, email address, speak slowly, spell out your email one letter at a time. Don't touch that dial because when we come back, Lou Batmale is going to finish up with Obamacare and giving us he's going to educate us.
Trying.
Try it. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money and Lou Batmale of LPL Financial. When we cut to the first commercial break, we asked this trivia question. What legendary Southern rock group had several of its members killed or injured during an airplane crash in October 1977?
It was the band named after janitor Leonard Skinner.
Janitor? No.
Was janitor, huh?
No, he was a PE teacher.
Was he a PE teacher? I forgot.
Yeah, his name was Leonard Skinner.
Yeah.
That's right. We were talking about this before, that apparently Waylon Jennings was supposed to be on that airplane. This is the story I heard. And he missed the plane. He also apparently missed the plane for the one that killed Buddy Holly. Yes. So he's kind of like a Flying Dutchman or something.
Yes, wow.
Kind of wild.
Richie Valens, too, yeah.
Yeah, that's right. And the Big Bopper.
The Big Bopper, yeah. So,
okay, go ahead.
Let me jump in here. So
Yeah.
this is the big thing. This is where a lot of confusion starts because we're talking about the Affordable Care Act and all the changes that are happening. For those 65 and older, which there's a big chunk of our audience
Sure.
that might be fitting there. So you have an additional choice to pay for your own health insurance. Medicare is still available. This is not changing or altering Medicare at all.
Okay.
Okay, the only thing is there's one change, and that's the reduction in the donut hole. So there's this big provision in Medicare that people talk about, like my prescriptions are covered, and my costs are covered. Then they're not covered for a bit, and then they are covered again. That's the donut hole, and that that disappears by 2021.
I thought a donut hole is one of those things you sit on when you have like hemorrhoids or something.
or the middle of the donut they don't want left over at the donut shop. Yes,
That's right.
donut
Yes,
hole. So,
exactly.
Yeah,
My
so
favorite part.
Yeah.
So you'll have a choice in enrolling in the health insurance plan through the exchange. So if you're over 65, you might say, hey, I want to get through the plan here. So if you have a possibly an ailment, remember the big thing here is if you have a pre-existing condition, it doesn't matter anymore. You're not shopping insurance saying, well, I have diabetes. Is that okay?
Because everyone's accepted.
Everyone's accepted. I have, macular degeneration. It's not a problem anymore. So people will be looking at this stuff saying, should I change my plan? So you could, but the odds are unlikely that you'll want to change out of Medicare.
Okay.
I've traveled to other parts of the country. I'm sure you guys have too. And here we're sitting in in California, in the Bay Area, where a lot of people are in generally good health. But I can't help but think that now I'm going to watch my premiums go up because now
Mississippi,
I've been on places in the States where you go to like a local park or a water park or a theme park, and the obesity of the population in those areas is astounding.
Well, everything's fried.
And the diabetes, and you just got to think of, the cost of health care to cover all those people who are abusing their health and making poor choices. Yeah. I don't see how this.
And smokers.
I don't see how it's going to work out financially.
Well, also, what kind of deductibles are we looking at Obamacare?
Well, if you log onto the website, you'll see. Deductibles range anywhere from, $40 to $60 to sometimes $80. I think 65 is kind of the max for copay. That's a copay.
That's copay.
That's a copay.
Okay.
Then
deductibles
deductibles for a family, I think, is $6,400, and for an individual is $2,500.
Okay, so it's very similar to regular
insurance right.
anyway.
Right,
okay,
right, yeah.
Because that's the problem though is if you have these copays that are so small or no deductible type of thing, people they get a little hangnail and boom, run to the doctor, run to the emergency room. Who cares? Someone else is paying for it.
Exactly. That's all. And now you get a penalty or you pay for the insurance. That's kind of the idea. And again, those penalties are going to go up. For more information about ACA and Medicare, I'm actually hosting a seminar on October 24th in both Santa Rosa and Ross, near San Anselmo in Marin County. So there's some discussion around current policies being grandfathered. This is an important provision, okay? Everyone's talking about why might be grandfathered. Those are for policies that didn't change after 2010, which is highly unlikely. We've had a lot of changes to your medical insurance since 2010. So I'd recommend checking with your insurance company to see if you have a policy that is grandfathered. They have to disclose that to you. If so, this will provide you additional level of flexibility. You can stay on your existing plan or enroll in the new ACA plan effective. So you have to enroll by December 15th. Remember that date? We wrote that down.
I wrote that down.
Yeah, so in summary, expect many of the costs associated with medical expenses, premium, copays, deductibles, and annual out-of-pockets to increase from their current levels.
Okay, remind the audience, because you went through that really quickly, about when your seminar is. Because, I'm looking at this going,
October 24th.
Eyes glaze over.
October 24th, I got 10 a.m. and 2 p.m. I think 10 a.m. is in Marin County and 2 p.m. is in Santa Rosa.
Oh, you're going to run up to Santa Rosa right after the Ross?
Exactly.
They're not going to let you go in Ross. They're going to keep asking you questions.
Exactly. So we're going to talk about that and the financial impact. So know your options. Understand what is important to you about healthcare, low premiums, low copays, broad network. That can be very important, and make sure you continue to educate yourself on how to best make a financial decision, because in the end, this is all about costs. That's
Okay.
really what it's all about.
Okay, let's move on from Obamacare to the shutdown
Okay.
of the government.
Are we
Comments?
Any bets on what, if anything, the Republicans gain or get out of Obamacare from the shutdown?
I can't see a position where we've been through the Supreme Court and they say, okay, we want to change something after it's been through the Supreme Court. So, in the end, the Democrats don't lose anything. The Republicans who are elected really don't lose much, because they're not going to go back to those constituencies, those areas where they're from. So like in California, for instance, San Diego and Riverside are big Republican areas.
Which are about the only two in the...
But I'm just giving for example. They're not going to go back there and say, we're going to get you out of here because you shut down the government. People don't care. People are fighting. But in the end, it's going to affect the markets. The longer this goes on, the government makes up 18% of GDP out there. They pay a lot of bills. They employ a lot of people. And the longer they stop paying money into the system, the bigger problem we're going to have economically.
But of course, most of them are still taking their paycheck, which is just abominable to me. I was listening to Armstrong and Getty this morning, and they were talking about the government shutdown on a couple of things, like the parks. And it's
Right.
like there's some open parks that there is nothing to do, and yet they're putting barriers around.
Right.
It's costing more for the barriers than
They're-
it would be to hire
Well, renting
somebody.
those barriers, installing the barriers, paying people to walk
Yeah.
around and guard people from going in.
Yeah.
Which
That's
they were
stupid.
going in anyway. It's not like it had a guard gate that went up and down.
Well, I think Yosemite's one of the big ones. Yosemite's all blocked off, isn't it? Or parts of Yosemite? I think you can't walk around right now.
They're gonna have to hire the bears to protect.
Where's
That's
Smokey?
Yeah, I mean, it's
Yogi,
just,
Yogi.
No, you know what? And then they what do they do? Cover the Lincoln Memorial, cover his face or something, so you can't see. They barricade these things, and it's all a front.
Right.
It's ridiculous. You know?
Yeah, it's like locally here, the Blue Angels aren't coming this year because of the sequester and all that stuff. It's kind of like window dressing. I mean, we all live without Blue Angels for 1 year, but to the same thing, it's what's it really costing?
It's all political stuff, right? Blame these guys. See, if they didn't do that, look what happened. Look what would have happened.
Well, one of the big things that the can't even say that Republicans were hoping was to get Obamacare to be delayed for a year, not necessarily. I mean, I think the whole repeal thing is just was never really serious, but but to stymie it for a year.
Why do they want to delay it? That's the big question. Do you know why?
No.
So
Because
do
the
congressmen
new
come and change
congressman
it?
comes in, they think they could
They
change it.
change it, yeah.
They're trying to
Yeah, 'cause-
they're trying to load a gun. They're saying, oh well,
Yeah.
let me load this gun for the next year and see
Sure.
what I can do.
Yeah, because even though the Supreme Court already voted on it, if
Right.
Congress can change the rules,
Right.
If they vote on it.
Yeah, so it's
Yeah.
kind of reloading the gun. So I gotta say, from an investment standpoint, I'm so frustrated because everyone's super nervous. And 2011 is all fresh in everyone's mind. 2008's still there, but 2011's there, and the market went down 20% in about 6 weeks, based on these same arguments. And it's just them not doing their job. So
Tell you what, we're going to cut to a second commercial break here. When we come back, we've got some very interesting emails that we're going to ask about. We're going to ask Lou, with the stock market so volatile, what are you recommending to your clients? So that'll be a good email. And Mark, we have one that has to do with your new real estate mortgage fund and the use of leverage. So we got some really good stuff coming up here. All right, here is our second commercial break trivia question. Again, the theme is, it happened during the 1970s. What was the name of the Pennsylvania location where a nuclear power plant suffered a partial core meltdown in March 1979? Don't touch that dial, because the best of investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my co-hosts Mark Hanf of Pacific Private Money and Lou Batmale of LPL Financial. And when we got to the second commercial break, we asked this trivia question. What was the name of the Pennsylvania location where a U.S. nuclear power plant suffered a partial core meltdown in March 1979? And Mark, you knew this one.
3 Mile Island.
3 Mile Island, very good. Okay, Lou, we promised the audience, excuse me, we teased them with what we were going to come back with, and I don't like teasing the audience and then not coming through. So we're going to get right into this email here. With the stock market so volatile, what are you recommending to your clients to ease the volatility?
I want to ask the question again. Why aren't we drinking while we're talking on the radio? That's all I want to ask.
When E.F. Hutton speaks,
That's right.
people listen.
There's,
Whatever
look,
happened to them anyway?
I could go in that off the air. I'll tell you what it is.
That's why they call him E.F. Nutton.
Yeah, exactly. So, this question's come up a ton with a lot of different people, and sometimes investing is driving down the highway at 70 miles an hour, looking in the rearview mirror. You look in the rearview mirror. This happened in 2011. It took us a long time to recover, but we did recover. Took about 4 or 5 months. So, these short-term blips will happen. We don't hit this political gridlock all the time. Unfortunately, too often in the last 5 or 6 years, and it does affect the market. As I mentioned earlier, the government's not spending money. That has a drag on GDP. If this goes on for 5, 7, 10, 15 days, that's going to, people won't get paychecks in time. Like that happened in California a few years ago. Remember that, where vendors weren't getting paid?
Oh, yeah.
The same thing's going to happen.
Or they got vouchers.
They got
or
vouchers,
something,
yeah. We're going to pay at some point in the future. Well, super. That doesn't help us. Doesn't help the economy move along. We are heading into earnings season from an investment standpoint, so we're going to hear a lot of different news. One key thing that people aren't talking about, this is kind of a factoid if you want to go there. This is the shortest shopping season ever before Christmas. In like the
In
last
terms of number of days?
number of days between Thanksgiving, I think is the 28th, is it, of November?
All right.
Oh,
Yeah,
okay.
so we're, last year's one of the longest, this year's one of the shortest. So a lot of companies are already talking about their, that's where you're going to see Christmas stuff and Halloween stuff's like already over. I think they're pulling off the shelves. And it
I'm
hasn't
already
happened.
seeing rabbits for
Easter,
already.
exactly. So my point is this: is that during earnings season, we're going to hear about a lot of this short shopping season. The debt ceiling debate, which is still happening on top of the government shutdown. How's it going to affect stocks? Well, I think it could have a pretty good impact on stocks. I think it could affect seasonal labor because there's such a short season. Who's going to hire seasonal labor? So I'm not saying jump out of the market. If you're allocated, you have so much money in stocks and so much money in bonds, and the big question is, why did they lose so much in bonds this year? Well, back in June and May, they said we might change interest rates.
Yeah.
The government stopped buying bonds, so interest rates jumped to almost 3%.
the interest rate did.
The 10-year interest rate went to
Yeah.
almost 3%. Now it's back down. I think it's 2.6 this week,
Yeah.
somewhere in that range. So when people get fearful, they start jumping back into bonds. I'm not suggesting a lot of quick moves here. There's no reason to do that because they can end this in 3 hours if they really sit down and start talking and doing their job, which
Yeah,
they're
but
paid to do.
too political though.
Exactly. So, it could turn around very quickly. So the problem about getting out or going to cash or changing your allocation drastically is you don't move back in at the right time. We still have people from 2008 that are not allocated correctly because they're still nervous, which is understandable, but it doesn't help you when the market goes up, 18% a year like it did this year.
You sound like quite the economist. How do people get a hold of you when they want to ask more questions? Because I'm sure there's a lot of people out there who have a lot of questions about this volatility, and they go, "Who do I trust? Who do I call?"
Just give me a call and you have some questions regarding your current portfolio. I'll say this, I've had a lot of people calling me last 2 months saying, I own only bonds, what should I do? And that's a
Yeah.
provocative question right now, because you really do need to make a difference in your portfolio decisions.
Okay, thank you. All right, Mark, we got an email that said, "Does your new fund use any leverage? If so, what are the advantage and what are the risks?"
Well, just on a transitional note, if the stock market is scaring you witless and you want to know about alternative investment strategies, at Pacific Private Money, we do have a mortgage pool fund right now that's paying secured annual returns to its shareholders of around 8.5%, secured by Bay Area real estate, with a portfolio weighted average right now of 53% loan to value. So just fabulous protective equity, security, and a great interest rate. And what was the question again? No, I'm just kidding. So does our fund use leverage to achieve those 8.5% yields? The answer is no, absolutely not. We do not use leverage, other than we're working on obtaining a line of credit that will help us close loans more quickly and then pay them down as new shareholder money comes into the fund. So that's an option that a lot of mortgage pool fund managers use. So it's leverage in a sense that it's that you're closing within a line of credit, but the idea is that as new investment money comes in, you would pay that line of credit
So
down
it's
to
short
zero.
term. It's not
Short term,
long
as
term.
opposed to a long term. There are funds out there that are using leverage to achieve higher yields in the fund. It allows them to offer lower interest rates on the note rate, but since they're using a leveraged fund, in other words, they're borrowing, let's say, 25% of the asset value as an example to boost the fund rate up and get those higher yields to investors. But no, we're not doing that, and that is a way that a lot of funds got in trouble prior to the collapse of the when the real estate market collapsed, funds that were using leverage, by and large, were hit with difficulties and liquidity issues, and some of those funds did not survive, and people lost capital. So, we're running our fund conservatively, and we do not intend to use leverage to boost yields, other than, again, for the short-term ability to close loans. So, for more information about mortgage pool investing, we have a sister show that, you just missed it because it was at 10 a.m. this morning on AM 960, sister channel to
KNEW.
KNEW AM 960. We have an hour-long show called Mortgage Investing 101, where we talk about trust deed investing and mortgage pool funds in great detail. So for more information, check that out next Saturday.
Okay, we're going to cut to our third and final commercial break trivia question. And here it is. Again, the theme is, it happened one night. No, it happened during the 1970s. What famous actress earned the name Hanoi Jane? The first three callers with the correct answer. You're looking at me with a blank stare there, Lou. The first three callers
Before my time.
Before your time. That is true. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Don't touch that dial, because when the best of investing comes back, we're going to have some closing comments. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Lou Batmale. When we cut to the third and final trivia commercial break, we asked this trivia question: what famous actress earned the nickname Hanoi Jane?
That'd be the fun and lovely Jane Fonda.
The fun and lovely Jane Fonda. That is correct. Okay, I'm sorry, Lou, you wanted to say one last thing before we...
Well, I mean, in preparing for today's show, I want to put it bluntly
hold
here.
on. That lets people know that we do prepare for the show. We don't just do it on the fly.
No, absolutely not. So put bluntly, all that's happening with the political divide is not good for the economy. The economic engine may be weak, considering unemployment's not going down and GDP is not expanding to that extent. So I want to tell people that the market's been hovering this year since probably about May. It's going to continue to hover, and the decision by the Federal Reserve not to buy bonds is probably going to steer the market towards this, do we believe it, do we not believe it type of scenario over the next 4 months. I mean, it's going to be a tough run to the end of the year, but don't jump out of the market. I think we need to buckle up for a couple weeks of earnings and corporate predictions and show that the holiday season, could be pretty tough this year with it being so short. So I encourage people, give us a call if you have a question, but more importantly, kind of stay the course a little bit. If you're invested, just stay there, okay? That's the big thing. 'Cause everyone's asking questions right now, and now is not a time to react.
And are you a fee-only planner, or?
Yes, fee-only planner, yes.
Okay, so no commissions on that.
Right.
One of the good guys.
Trying.
And in fact, Mark, on your investments, there's no commission either.
No, that's one of the great things about trust deed and mortgage pool investing is it's no load, no fee. 100% of your money goes to work for you, and when you redeem, you get 100% of it back.
That's what I love. You guys are just in this for your health.
That's it.
Well, in our case, the borrower pays the fees.
There you
So,
go.
At Pacific Private Money, we do loans to real estate investors who pay origination fees on that money. But the private lenders who fund those loans, all of their money goes to work right away. It's no load, no cost, no fees to them.
I love that.
Yeah, it's amazing. So anyway, I had a couple of articles. In fact, anyone who was listening last week's show heard me talk about an article I saw in the one of the local blog reports that talked about the number of negative equity homes in California plunging to 15%, down from nearly 30%. And what I want to bring up is, there's a lot of numbers and statistics that get thrown around all the time, and oftentimes they can be a little bit misleading. And so this week, I find an article in PropertyRadar.com, which was formerly ForeclosureRadar.com, and very, very good blog, very good articles in there. And here I'm reading something, and I scratched my head. I had to go pull last week's article because it said in August, this past August, 2 million or 29% of California's nearly 7 million homeowners with a mortgage are underwater or barely above water. And so the key is that last week's article talked about 15% of homes are underwater, but being at or slightly above in many cases is leaves homeowners in the same predicament. I mean, if you don't have enough equity in your house to sell it and put money in your pocket, you're stuck. You can't sell. So there are people out there who want to move, and they're in this near underwater. So this week's article by Property Radar talks about, we're still 30% of homeowners with a mortgage are stuck in their homes. They're not necessarily underwater. Their mortgage may be less than the property value of their home, but the difference between the mortgage and the property value is not enough for them to be able to sell it, pay a 6% commission, and have money in their pocket that would allow them to move.
So what do they do?
Well, what they do is they wait. And so the point of it is that we still have, a long way to go in this real estate recovery we're in. And there's a lot of variables that we're looking at. So if interest rates do rise, one of the challenges is how is that going to affect the increasing real estate prices that we've been seeing in the last year? Is that going to continue going into next year? Or are we potentially looking at flat prices or maybe even a slight decline or correction in real estate prices if mortgage interest rates in 2014 jump to 5 or 6%? That's the big unknown.
Well, right now, as we mentioned, we hit 3% of the 10-year rate just a few weeks ago, and now we're coming back to 2.6. But
which is good news.
That for investors, that we came back. For investors, they went higher, above 3%.
But the home
but homeowners wanted at 2.6. Yeah. So the question is, what's that line that we cross for mortgage rates where people are like, okay, we're never going to be able to do anything, or the demand for housing will go down? And I think it's not far from where we are today. That's part of the problem, don't you think? If we went up 75 or even a point and a quarter from where we are today on conventional mortgages, how much would that slow the market in your opinion?
Well, that's the big unknown. Because we've had a decade of being spoiled by these low interest rates, and we've talked on previous shows about how a 6% mortgage, we would have killed for a 6% mortgage 10 years ago, right?
Right.
And in fact, the historical weighted average, if you go back 30 years, is 6-7% for mortgage rates.
Spoiled.
Right. So, but now it's like, oh my gosh, 5%, or 5.5%. But it's and really, actually, it's not so much the rate itself. It's that real estate prices increased proportionally as a result of money rates going down.
Right.
And so now your dollar, your income and the percentage of income that you can dedicate to your housing will buy you more housing at 3.5% and 4% than it would at 6, 7, or 8%.
Well, I think that's the bigger part, is that every 1% that goes up in mortgage rate costs X amount extra in monthly payment. And I'm kind of curious, you said they changed the name from foreclosureradar.com to Property Radar?
PropertyRadar.com.
Why?
Yeah. Actually, I don't know. I haven't.
Foreclosure sounds kind of negative, guys. Come on.
Yeah, but that was
Probably
the whole
was.
thing. That was the whole idea, though, was to check on the.
Yeah. No. The thing is, going back to this, the Fed made a big decision last month not to stop buying bonds. And buying bonds means it keeps your rates artificially low. But people are forgetting there's one key component to what you're discussing. That is the discount rate they charge the banks. That's still at 25 basis points.
Yeah.
And right now, this week, I think Bill Gross did a really compelling article where he talked about Janet Yellen will probably be the Fed chairman after Bernanke, because Summers is out now, and that until she takes over, they're not going to stop the bond buying program. More than likely.
Bernanke wants to go out with a bang.
Wants to go out.
They want her to take the heat.
Totally. That's talk about kicking the can.
Up.
Yeah, and these people don't make a lot of money either. You got to remember that. Who was the woman who took over Cal Berkeley's? Tripled her salary from where she was as Homeland Security Chief, Janet Napolitano. It's just like ridiculous how little they make working for the government.
But I was gonna say, how much does a Fed chairman make?
Oh, I think it's under 200,000.
For that position, it's actually pretty low.
It's one of the biggest positions in the world. So,
but is he getting paid now that the shutdown's going on?
Good question. They probably need to keep him employed. But
the Fed is not part of the government. Don't forget, it's an independent arm. So
yes.
The shutdown does not affect the Fed chairman's
that's
salary.
right. That's why the president is still taking his $200,000.
It's funny that you said that, because actually a lot of people, if you polled the public, I would bet a majority would answer the question, "Oh yeah, the Fed is part of the government, or an arm or a branch of the government." Yeah. It's actually an independent, for-profit organization. Yeah.
And they said besides them, the bond
run by
buying
scary wealthy people, I might add.
Yeah, true. The bond buying program won't stop until next year, 2014. And they said the prediction right now is 2016 is when they're going to start raising rates. You know how the Fed used to raise and lower rates?
Yeah,
2016. Could you
thought
imagine?
They thought it was
That's how bad it is out there.
2014 is what they said
Wait,
a couple of years ago. They said 2014.
Right, when they stopped the bond buying program.
Yeah.
But now they're adjusting it and extending it
Are
longer.
they just
That's-
saying that the economy they don't expect the economy to do well until then?
Right, the unemployment rate's not going to go down far enough, and GDP's not expanding enough. I mean, if you look at companies, their top line number, okay, they're all profitable. They're all passing profits on to their investors via dividends and buybacks. That's great. That's how investors get paid. That's how your investors get paid, right?
Yep.
They get interest rates. So
Yep.
the idea here is that that system's in place, but is Target making more money than it was last quarter? Is GE making more money than it was last quarter? The answer is not that much more.
Really?
It's not like these things are growing exponentially. GDP is not expanding exponentially. So this hovering position I'm mentioning, it's kind of a tough spot. And that's where you're like, is it better to get 3% yield in a stock or 3% yield in a bond? It's like, that's the question everyone's asking themselves.
Well, here's something they do. The federal government can just print more money and hire everybody who's unemployed, and then you have zero unemployment.
Right, exactly.
And I don't know what they would do, but you get them employed.
Yes.
Well, if you're a real
estate.
estate investor, that's great news to hear that the Fed is likely to consider keeping interest rates stable going forward for the next couple of years, because again, the idea that mortgage rates would spike up to 6% or even more. Certainly would have an downward impact on real estate. And so if you're buying, fixing, and flipping real estate, you don't, you better do it quick. You don't want to be holding property for a year or 2 years, hoping that prices will continue to go up. But that's actually good news. That would lend to at least stability in housing prices, and maybe not the type of appreciation that we've seen in the last 12 months, as there's been kind of this bounce back recovery. But I kind of like the idea of a steady, predictable interest rate, and if it's rising slowly, because again, it's the stability and the predictability, I think, that really are the most important things for an investor to be able to rely on, and certainly in the real estate market, that's important. I think a healthy, 5% appreciation would be lovely to be able to look forward to in the next few years, and hopefully not any kind of runaway
and
bubble.
obtainable. I mean, these
And
returns
obtainable,
these returns in real estate right now are not obtainable over a long period of time,
Right.
traditionally.
Very good.
So lastly, I've got an article here, I think it was last week, Robert Schiff was talking about this company that was helping people with their down payments. It was a down payment assistance. And so there was actually an article in the Chronicle last week, if you want to go back and look it up online. A company called First Rex there was an example here of how they were charging 40% of the gain in the home and providing 10% or half of the down payment. So, and their program is for high-end homes in California right now. So, like for example, $800,000 and above, they will help you with your down payment. You come in with 10%, they'll come in with 10%, and their only charge is a portion of the gain when you sell.
Shared
a home.
Appreciation.
Shared appreciation
All right.
mortgages. Yeah.
Thank you, guys. Thoughts for the day. Now I know why it took me 6 years to finish high school. When asked where the Declaration of Independence was signed, I said at the bottom. And when asked to name 6 animals that live specifically in the Arctic, I said two polar bears and 4 seals.
Nice.
Yeah, that didn't work
Yeah.
out very well. All right, I want to thank my co-hosts, Mark Hunt of Pacific Private Money, California's fastest growing private lender, and Lou Batmale of LPL Financial. Thank you very much for that information on Obamacare.
I'm reading these articles on a daily basis about what's going to happen with the Consumer Financial Protection Bureau. And to step back a second, the Consumer Financial Protection Bureau, headed by Richard Cordray, who was appointed by President Obama, he is going to, on January 10th, begin to enforce the regulations of the Dodd-Frank bill. The overseer of all this is the Federal Reserve. But there is no congressional oversight of the CFPB. They basically have an open license to audit and go out and fine. Congress has no oversight, so it's a single entity.
And isn't the Federal Reserve a private entity?
Yes,
A lot of
but
people don't know that. go ahead.
so you have all of this guidance coming down, and the end result of it is that, and the subject of this article is, mortgage markets will pay the price for CFPB's contradictory policies. So you have all of this regulation going into effect. Not a lot of it is clear. Certainly none of it has been tested. And yet you have the consumer at the other end who somehow has got to fuddle his way through this, and you have to hope that the lenders that are making these loans can continue to do so at price points that are competitive for the
So,
consumer.
Mark, how does that affect you? Because, again, I keep thinking that with all of this kind of junk that's going down, I would think a company like Pacific Private Money would actually do pretty well, because these people are going to have a hard time getting loans at the bank. They're going to come want to see you.
Well, you'd
Come
think
once
that
a year.
actually that it's not something that the private lending industry is going to be able to come in and save the day, and here's why: because we're covered by the same rules as the banks are with respect to consumer lending.
Right.
So really, what
Primary homes,
the
et cetera.
Consumer Financial Protection Bureau is going to be doing is protecting the poor. Unknowing
Right.
consumer
You know what's
from
gonna-
the
what-
big bad predatory lenders
That's right.
and the
So you know
big
what's going
bad
to happen?
banks.
Everyone's going to fill out an application, and no, it's never going to be a primary residence.
Well,
Right? nobody lives there.
Right.
you take that a step further. There, of course, are when you go in and you buy your primary home, you sign a primary occupancy affidavit. It states your intent
Right.
to live in the property for 12
Well,
months.
that affects banks.
Right.
How does that affect the private lending?
I think what you're really getting at, hold that question, is the fact that how are people going to begin to make ways to work around what they can't otherwise do?
Yeah, because right now the banks, I mean,
Right.
one of the things they'll do is they'll check to see if your utility bills are being sent to that address. Mark, do you do that?
No.
Okay. And with that, we're gonna cut to our third and final commercial break. This is too much fun, guys. What was the? I hope the government's not listening to. Is the government listening? To
Government's
this
not listening to anything.
Oh,
I think that's how this whole thing started.
Yeah, but we are on TV too. So government, turn your TVs off. Okay, here is our third and final trivia question. What was the mythical creature who was serpent-like with many heads? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. I see a couple of blank stares here on this
Yeah.
I was waiting for the half man, half goat.
one. Goat Man?
Goat.
Goat Man, okay. Their website is lighthouseforfun.com. Call 888-912-1190. What's our number again? 888-912-1190 to answer this question. What was the name of the mythical creature who was serpent-like with many heads? Make sure to include your name, email address, speak slowly, spell out your email one letter at a time. Don't touch that dial, because the best of investing. We'll be right back.
I don't know, but it played a liar.
Go move my car,
right?
Ed.
Yeah,
Oh, you move your car and I gotta go.
That's right.
Okay.
the goat man.
Yeah, I won't touch yourself.
You might told me.
Okay.
With when I've had those spells where it seems like that's just the way it's
Where
going
no
on
one,
every
where,
day.
where people are just don't realize how insulting they are to you.
Yeah.
Because they
Yeah.
don't value,
Value
your
your
service.
time
Yeah,
or
your
service.
time.
Yeah,
Right,
it's
exactly.
but you have to be especially careful that it doesn't show up in the tone of your your voice when you speak with your next
totally.
client, because
Yeah.
Oh, yeah.
it's so
It's too easy.
yeah.
You said you wanted to end on an up note?
Sure, we'll just say hey look.
We got 11 minutes, 11 and a half
Oh,
minutes
okay.
to go, so
All
we
right.
got some time.
Oh gosh, I thought it was a short one for some reason.
What did you want to...
What I was just going to say is, we've weathered a lot of storms over the last 5 years since the downturn in the real estate economy, and the good players in the lending industry continue to find ways to, provide excellent service and great pricing
Okay.
for consumers.
Let's do that, and then
Yeah.
let's get into a deal of the week with you.
Okay.
Because you got some good deal to talk about. I'm sure you do. Ready? Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf and Robert Spinosa. When we cut to the third commercial break, we asked this trivia question. What was the name of the mythical creature who was serpent-like with many heads, and it has nothing to do with the Kardashians?
I'm batting zero.
Betting
Yeah,
zero? The answer is Hydra.
oh wow.
Yeah, very good. Okay. Robert, with all of these, kind of discouraging things we were talking about the whole show, you wanted to start talking about some positive
Yeah,
things.
you
Go
have
ahead.
to be really careful when we start talking about the regulation that hinders our ability to do things. we've endured a lot of restriction and changes since the fallout of the real estate economy. All of us in here, you know, I know Mark, you guys have as well.
Oh, yeah.
And it's especially important for the consumer to know that there are a group of us out there. Certainly, it's the culture at RPM where we are really, we are intent on serving the needs of our consumers and clients, and we are happy to be of service and shepherd people through these things that they might not otherwise know about. And I think that it's good for people to be informed about them, but it is also incumbent upon the lender to educate anybody looking to buy a house or refinance a house what's going to happen in January, how to protect themselves from the
That's why I think it's more important now than ever to have a good mortgage broker.
Yeah, and you know, with rates are still very good. It's very easy to see only the gloom and doom in the press. Rates are up a percentage point and all that, but still very good. You still have a lot of opportunities. Bay Area home values have appreciated wonderfully in the last 12 months, and so great opportunities still exist, and anybody who has questions about that should seek out the answers.
Yeah, you know, it's kind of strange too, because I was thinking that oil prices were going up, but for some reason gas didn't really necessarily go up so much. It seems like it's all a game, so it's like if you're going to play that game, get your interest rate locked in now.
Yeah. Take advantage of what's available and avail yourself of what's available. I guess the best way to put it.
Well, Robert, I sure appreciate your attempt to, at least in this final segment of the Best of Investing, to kind of put a positive spin on some of the stuff that's coming down the pike. But I got to keep going back to just kind of, shaking my head here.
Yeah, well,
audience, you can't see me shaking my head, but we've already had many new regulations enforced in lending, which have affected bank lending and as well as private lending, hard money lending. We had some regulations go into effect in 2012, and then we had another bunch go into effect in 2013. And I'm shuddering at what's coming down the pike in 2014, because it's just really, it's unfortunate. Because it's well intended, and the well intention is to protect the consumer, from
himself.
Well, from banks that would take advantage of you, from predatory lenders that would take advantage of you, i.e. subprime, et cetera, mortgage brokers who are only concerned with putting commissions in their pocket, who would take advantage of you and sell you a loan that really you have no business being involved in.
Selling the dream.
But I'm not a pessimist in terms of, well, it's just, we're not going to be able to lend you money anymore.
Right.
Notwithstanding, I don't care how many new laws they put into place. If it turns out to be inappropriate and it actually does constrict the flow of capital to the extreme, there's going to be a backlash. There absolutely will be, and so
there's always going to be opportunities out there.
There's going to be an opportunity. New opportunities will come up. Nature abhors a vacuum, and it just really, no matter what happens, there will always be a reaction to it.
So speaking of opportunities, I don't know if the audience, you've told them what you do for a living with the hard money loans. Give us an example of these opportunities, like someone came to you who wanted a loan.
Well, I talk a lot about how Pacific Private Money makes loans primarily to real estate investors who are buying, fixing, and flipping real estate. But we also do some rather interesting loans right now, and it seems we're doing more of these than ever. And these are consumer home loans, purchase loans, for certain situations where the consumer either should have been able to get a bank loan but couldn't for a specific transaction, and rather than lose the opportunity to buy that home, they go to a private lender and pay higher points and higher fees.
So they start off maybe trying to go to Rob for the best loan out there, the cheapest price, and for whatever reason, they just couldn't get it done.
Yep.
Okay.
Right, and they didn't want to lose the opportunity, and so we're seeing a lot more than that. And we refer to those as consumer bridge loans, and it's a bridge because it bridges the gap between the fact that they need to close that purchase transaction now or lose it, and it bridges it between the period of buying the property and the period and the ability to conventionally or
refinancing.
obtain a conventional bank loan. And if that can happen within a 1-year period, that's the restriction. We are able to make what's known as a temporary loan to a consumer and privately fund it and charge the fees and the yield that we need to charge in order to entice private money into the lending opportunity. And so if we can do that and within 1 year the consumer has a viable exit strategy, and oftentimes it's just simply, hey, I'm still living in the house that I own.
Right.
It's on the market to sell. I know it's going to sell soon, but I really want to, I'm in contract for this other house and I got to close.
So legally, you can make that loan.
Yes, absolutely.
Okay,
It's
because an enticement, I mean, if you're paying me 8% interest, that's pretty enticing for me as an investor.
Right.
Right, so we can make a loan to help that consumer purchase that target property, or the upleg property as we refer to it as, while so we help them close, and then once they sell the house they're living in now, or maybe they'll actually move into the new house, which is more oftentimes the case, and then have that other home on the market. It'll be vacant, maybe even easier to sell then, and then that loan would then pay off our loan, and then, or it would pay down a portion of it, and then the remainder would be paid off when they conventionally
Yeah, because
refi.
contingency.
That's tough.
There's
Very-
no
very
way.
good point, Adam.
Nowadays,
Yep.
you just can't buy a property and say, "Don't worry, Mr. Seller.
When my house
when my
sells."
house sells."
Right.
Yeah. No.
There was also a situation where there was a family in contract for a home, and it was being built for them. They bought it in a new subdivision, and it was going to be a 6-month process between the time they put their money down, the deposit for the contract, and the time that they were going to close. So they were well qualified to close at the time they entered into the contract, and the builder started building their home. Well, the bank got ready to put the loan together to close once the house was completed, and they pulled their credit, as they do, because it had been several months, and there was an unexpected tax lien that showed up.
Right.
It was incorrect. It was
Screeched to a
wrong.
halt.
Yeah,
Right.
but
Yeah.
incorrect.
It was wrong.
It was
but,
a wrong one.
but it was going to take
Right.
up to 90 days to remove that loan, and the builder wasn't going to give the home buyer
That
90
loan,
days
yeah.
to close. So rather than lose the home and a $50,000 deposit, they came to us for a short-term bridge loan, and we were able to provide
that's
that
a
for them.
perfect example of how that is still a bankable loan.
Yes,
But because
absolutely.
of timing, that's why when a lot of people say, I don't want to invest in hard money loans because it's too risky. Really?
Right.
The bank is going to make that loan.
Right.
It's just going to take an extra few months.
It's not risk, it's understanding risk.
Yeah.
Yeah.
I mean, everything's got risk.
Right,
And
everything's got risk.
I said this before. When I go to XYZ Bank and they've got that little emblem that says
Right,
FDIC
right.
insurance, really? How do I know they paid their premium?
Right.
How do I know this isn't all false? I mean, at some point you have to assess the risk and manage it and say, well, okay, my guess is Wells Fargo Bank has been around probably for 150 something years. My guess is they probably did pay their FDIC insurance
Right.
premiums. Probably my 100,000 is, or whatever I've got, used to have 100,000 is safe. I mean, come on. At
Right.
least the thing was with the hard money loans is that it's invested in the real estate. It's
Right.
backed by the real estate, and it's not backed by some,
Right.
napkin.
Idea. Yeah.
Investing today is very difficult. Everyone knows about the traditional investment options: stocks, bonds, mutual funds, CDs, annuities.
You mean all the risk-free ones?
Right, all the supposed risk-free ones, and these are all the ones that your typical financial planner
Correct.
or investment advisor wants to sell you because, well,
Commission, baby.
right, they can earn commissions on it, or because they're readily tradable, they're liquid,
Right.
with the exception of CDs, of course, but these
Or
are
actively managed accounts where they
Right.
charge a
Right.
fee.
by far and away, most people invest their savings, their money, their retirement savings in one of those. But more and more people today are starting to research what are called alternative investments, like mortgage-secured trust deeds or mortgage-secured mortgage pool funds, and to earn 8% or more on their money.
And so again, in case the audience joined us fairly late, how do people get a hold of you if they want very well protected 8% returns?
So for more information on mortgage investing and how you can earn 8% or more using your savings, IRA money, or any money under your mattress, we don't care where it comes from.
Oh, you don't season the funds. How about that?
Yeah.
No,
Nice
we don't.
concept.
So
Good.
call Pacific Private Money for more information about mortgage investing. We're here in the Bay Area, or go to the Best of Investing website. That's thebestofinvesting.com, and you could read about all three of, actually there's multiple co-hosts on the
Does it
Best
see
of
what's on
Investing,
there?
and find out how to reach any one of us.
Okay, and here's our thoughts for the day. I wonder how some people can keep up with their Tumblr, Twitter, and Facebook. I can't even keep up with the Kardashians. And there are two types of human beings found on Facebook. One who gets enormous amounts of likes and comments on their posts, and the others are men. All right,
Indeed.
audience, you've heard some excellent stuff. Rob Spinosa, quickly, how do people get a hold of you?
Bestofinvesting.com, 877-270-5959, RPM Mortgage.
Yes, you have questions about mortgages?
Give me a
Call
call.
Rob. He's the man.
Yep.
Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.